let's pull back the curtain on one of the world's most powerful and mysterious financial institutions.
You ever wonder who really decides the interest rate on your car loan or your mortgage? Well, it's not just your bank. There's a powerful agency behind the scenes, pulling all the strings. And that's the Federal Reserve System. You probably just know it as the Fed. So why does it exist? Well, the Fed was basically born from a history of total financial chaos and banking panics. Yeah, back in the late 1800s, the US was hit by one devastating bank panic after another. So Congress had to do something. In 1913, they created a central bank to try and stop the chaos. Its main job was to be a lender of last resort, to stop massive bank runs. Okay, so how does the Fed manage the entire US economy? It all comes down to a few key tools. These are its main monetary tools. But honestly, let's just focus on the most important one. Its primary tool is the interest it pays banks on the funds they keep in their reserve accounts. See, this one single rate influences what banks then charge each other for overnight loans. And that starts a chain reaction that ultimately affects the interest rates on your loans. But what's the whole point of all this? The Fed is actually trying to hit two big targets. This is its dual mandate from Congress: maximum employment and stable prices. It's a constant balancing act. Now, for that stable prices part of the job, the Fed has a very specific number in mind. It's shooting for an average inflation rate of 2% per year. That one number guides everything. But, having this much power is controversial, and the Fed has a lot of critics. Nobel laureate Milton Friedman famously argued the Fed's own mistakes actually helped cause the Great Depression. Other complaints? A lack of transparency and a history of bailing out huge financial institutions. So this all leads to a really central question about the Fed's role in our financial lives.